If a single small trade suddenly drops the spot price by $100, the total market capitalization instantly loses $2 billion. That headline number is an illusion, dictated entirely by the volume of the latest marginal trade. Standard market cap is calculated through a simple formula. You take the last traded spot price and multiply it by the total circulating supply. The flaw in this math is that it assumes every coin in existence is highly liquid and available for sale at that exact spot price. It ignores millions of dormant coins held in cold storage, distorting our view of the actual capital invested in the network. To map the true structure of the market, we have to look past the last traded spot price. We need a metric that tracks the actual historical capital that has physically settled on the ledger. This brings us to realized capitalization. Instead of valuing the entire network at today's price, realized cap isolates every single digital coin, or UTXO, and values it at the exact price it was trading at the last time it moved on-chain. By adding up these individual historical timestamps, we extract the total cost basis of the network, stripping away the daily noise to reveal the exact amount of dollars sunk into the asset. This dense, slow-moving metric exposes the core tension in the market. On the surface, you have the highly volatile, speculative premium of the spot price. Underneath, you have the hardened bedrock of actual invested capital. Measuring the mathematical deviation between that volatile surface and the bedrock below gives us a structural map of the market. It shows us exactly when the system is under severe capital stress and when buyer exhaustion is reaching a historical extreme. This MVRV Z-score chart maps the volatile black market cap against the blue realized cap. The orange line below measures the deviation. When it spikes upward, the gap between spot price and invested capital has stretched to extremes. The market is saturated with unrealized profit. Net unrealized profit and loss, or NUPL, translates this into percentage bands. The blue line moves through colored sentiment zones. Notice the 75% threshold in the red zone. When 3/4 of the network's value is unrealized profit, the overwhelming incentive to sell buckles market structure. Cyclical tops do not happen because the price hits arbitrary lines on a technical chart. They occur because aggregate unrealized profit reaches critical mass, creating an inescapable mathematical pressure to sell. Aggregate data blends opposing psychological profiles. To get higher resolution, we split the network into two cohorts: long-term holders with coins dormant over 155 days, and short-term holders whose coins moved recently. This chart tracks the short-term holder realized price. The orange line of recent buyers' cost basis weaves tightly around the black spot price. This reactive cohort acts as dynamic support during uptrends, but flips into rigid resistance during downtrends as trapped buyers sell at break-even. Contrast that with the long-term holder realized price. This orange line exhibits smooth, stepped ascents, isolated from daily volatility. It functions as the ultimate valuation floor. Generational bear market troughs happen the exact moment the plunging black price intersects this deeply entrenched floor. Market direction relies on a simple test for these two specific groups. Either the short-term speculators successfully defend their break-even cost basis, or they capitulate completely, driving the price down to the absolute floor. By tracking these two distinct groups, we can observe the actual supply transfer mechanism that dictates major macro cycles. Over time, coins predictably migrate back and forth between short-term speculators and long-term accumulators. In this long-term holder supply chart, the blue area expands during flat bear markets as patient capital absorbs supply at the floor. But during distribution, as price goes vertical, the blue supply line drops violently. Long-term accumulators hold incredibly heavy, illiquid positions. To take their profits without collapsing the market entirely, they require the massive influx of euphoric retail liquidity that only arrives during parabolic bull runs. Absolute macro tops land at the exact inflection point where the sheer volume of long-term distribution finally overwhelms the incoming retail demand. That covers the broad macro shifts. But to understand the violent, localized price action within those multi-year cycles, we must examine derivative markets. This chart tracks perpetual futures funding rates. Green positive bars and red negative bars over the black price line gauge age leverage weight. Elevated green spikes indicate traders paying massive premiums for longs. This creates a fragile, top-heavy environment, perfect fuel for a brutal liquidation cascade. Even when the macro on-chain fundamentals are structurally sound and long-term supply is tight, extreme derivative leverage can always force a violent, localized market reset. Let's bring this all together to diagnose the state of the market in mid-2026. By stacking our 3 data layers into a single dashboard, we get a complete cross-section of structural health. On the top layer, we check where the current marginal price sits relative to the short-term holder cost basis. This immediately tells us if recent speculators are in profit and providing dynamic support, or if they are trapped underwater and acting as resistance. Next, we evaluate the middle layer, NUPL momentum and the velocity of long-term holder supply. This reveals exactly how close the broader market is to a state of aggregate exhaustion and mathematical sell pressure. Finally, we check the funding rates on the bottom layer to spot any immediate, localized risks of cascade liquidations brewing in the perpetual futures markets. Treating these metrics in isolation gives you noise. Synthesizing them provides a clear, high-resolution view of the mechanics driving capital flow. The daily fluctuations of the marginal spot price are often a distraction. The actual mechanics of capital flow, who is accumulating, who is distributing, and what it costs them to do so, are permanently etched into the ledger.